Okay, we're ready to start part two of this module two, week two material. If you like more journal entries and calculating actual taxes, you'll like this better than maybe part one, which was more administrative, knowing who you can count as an employee, what are the laws if you're an employee, what rules you have to follow. For me personally, I much prefer this part two stuff. I like the calculation of stuff, figuring out puzzles. I'm not so much of the administration type thing. That's just not my thing. So that's why I'm not really in HR. That was more of the HR side. This is more of the accounting side. All right, so the first thing we need to know is gross wages. We talked about that in week one briefly, but gross wages is what you actually earn. Net wages or net pay is what you actually take home, what your check's written for from your employer. So your gross, and then you subtract all of those taxes and other withholdings that you have, and then that will become your net pay. So the other withholdings would be things like your retirement pay that you have put aside, pay for medical premiums. Maybe you have some money withheld for dependent care or garnishments. All right, so we looked at this last week, but we're gonna just quick review here. The things that the employee pays and then the items the employer pays. The things that the employee pays are the five. Remember, we talked about these: Social Security and Medicare, and that's what we're going to really focus on this week. We're going to look at these two in detail. And then we're going to look at, in weeks 4 and 5, the other three items: the federal tax, income tax, the state income tax, and then the county income tax. The employer, remember, the employer has 4 main taxes that they have to pay in addition to what you pay. They pay the exact same in Social Security and Medicare, and then they also pay any unemployment taxes up until you hit the threshold. And we're going to look at that in a lot more detail come week 6 in module 6. All right, the first thing to talk about is what's known as Social Security and Medicare. When they're combined, and a lot of times they are, if you look at your paycheck, sometimes they'll even be combined as one amount, and it'll be called your Fica taxes, because that's where these two payroll taxes came from. Was this act back a long time ago in like the 30s, this Federal Insurance Contribution Act, which set up a mandate that companies have to take out money for Social Security for you to have money mandatory put away into your retirement, and that the employer also has to put in money to it. They have to match it. The same with having some at least basic health care. When you're at a retirement age of 65, you also have to put money into this Medicare. Now, this is the most basic Medicare option. It's just covering your hospital stays, but the employer also has to chip into that, and then they set a rate. So let's dive into these, the two FICA taxes. The first one here, Social Security. We've talked about in week 1. We talked about this, but this is just a good refresher, and then we're going to actually look at some issues that evolve when it comes to being close to your cap, what you do. Like, we began to do that with the Fica taxes in week 1, but we're going to now look at it here further in for Social Security. So what we're going to use, even though you may be viewing this in 2021, we're still going to be using the 2020, because it's difficult to update this course all the time, every year that the numbers do go up, because they do go up every year. So usually we update this course every other year. So for 2020, and we're going to use it for 2021, the Social Security cap we're going to use is $137,700. Now that's something you're going to want to remember. It definitely going to remember the 6.2%, but this 137.7, have that down as well. The previous caps, as you can see, they do go up every year. So back in 2018, it was 10,000 less, and then it went up 5,000 approximately. It doesn't always go up about 5,000. It's somewhere between 4 and 5. One year, a couple of years ago, it actually stayed the same. The inflation rate was deemed to have been flat, and it didn't move. It didn't go up. Any. The key is, once your wages, your taxable wages, hit that cap, then you're no longer taxed for Social Security. So a professional athlete who makes $2.1 million this year, only their first $137,700 is taxed for Social Security. The rest of that $2 million, they don't have to pay Social Security on. And so you think, ooh, that's a break for the rich. Yes and no, because remember, Social Security is basically your money. You're putting away money for your retirement later on. And if you only put away up to $137,700 this year, then they're only going to calculate what you get in Social Security based on 137.7. They're not going to base it on the 2.1 million that you made this year. It's going to be capped at that amount. So yeah, it's kind of a break for the rich, but it's also when they're later in retirement, they're not going to get retirement wages anywhere near what they made now. Social Security, if you look back and through some of the rules and the laws, it's also known as OSADI. If you see that anywhere, that means Social Security. And this is what it stands for, the Old Age Survivor and Disability Insurance, because Social Security does pay for those who are disabled. They do disabled, if you qualify, they do get checks from Social Security. That forces retirees, basically that's what it does. It forces you to put money aside because you didn't want to become 67 and then not have planned very well and have nothing when you retire. So this does allow you to have money, at least enough to hopefully to live on. Remember we talked about this in week 1, the Social Security, the cap, and then actually how much you're paid per year depends on what's called the Consumer Price Index. And what they do is they put a whole bunch of different items into a bucket and they say, okay, these 5 food items, if we were to buy this bag of cereal and this loaf of bread and this gallon of milk, it cost me this much. And then here's how much gas costs for 30 gallons that I need for a month. And then this is what it is for electricity. And then they add it all up. And then they compare that. Well, how much did it go up from last year? Did it go up 1%? Well, then there's going to be a 1% increase in the Social Security cap or in what your Social Security pay is going to be. They're going to try to always keep it even with inflation. That's how they go about determining it. And that's what's called the cost of living adjustment or COLA. I thought these were some fun facts. Back in 1999, some of you weren't even born yet. Some of you, like me, would have been in high school perhaps at this time or just out of high school. The Social Security rate at that point was only $72,000. So it was quite a bit lower. You can see how much it's went up just in the last 20 plus years. Back in 1970, it was only $7,800, which in today's wages isn't, you think, oh, well, back in those days, the wages weren't as much. True, but they were still worth more than that. That's only equivalent to making $45,000 today. So it'd be like having the Social Security cap at $45,000, which it's definitely not. So either it would appear then back in the 1970s and 80s, they weren't quite taking out enough for Social Security. They should have probably been taking out more, and that's why the cap has gone up faster than it did way back when, because they stopped it at $7,800, and that would have only been, an equivalent to today's wages. There would be a lot more people who hit the cap. Medicare, you're taxed at 1.45%. Everybody's taxed that, no matter how much you make. Some are actually taxed higher than that. With the new Obamacare that came out back in 2014 or 2015, actually in 2013, sorry, then you are actually taxed a little bit higher if you make good money. Well, take a step back here. This Medicare, this is the very basic. This only covers if you're in the hospital, your hospital bills. It doesn't cover doctor's visits or prescriptions, the two biggies that usually come up. Most of the time, you're not in the hospital. Now, but if you are, then this is going to help pay for that because those are the big bills. But hopefully, those don't happen too often. It's these other smaller ones that happen all the time, like your MRI, a CT scan. Those can be quite pricey, and you're going to need additional insurance beyond just the normal Medicare that you pay for right now in your wages to get taken out. So note here with the beginning in 2013 with Obamacare, you're going to be taxed an additional 0.9% over on top of this number if you make over 200,000 and you're filing a single, or 250 if you're married filing joint. So just something to keep in mind, and notice that's only on those dollars above that. So if you made 200,000 in $1, the first 200,000 is taxed at this. That next dollar that you made is then taxed at the combined rate, the 1.45 plus the 0.9, which is this. So that's only on the wages above this threshold. Even though the Obamacare penalty for not having insurance was repealed, this mandate still continues on. So I wanted just to show you an example to make sure we kind of got this, what I mean by only the dollars above 200,000 or 250 if you're married filing joint are taxed at the higher rate. So let's look at this little example here. We have a married filing joint couple, and individual earns 400,000. Maybe the other maybe the other spouse doesn't work. How much Medicare would this individual have to pay for the year? So if you want, go ahead and pause and see what you get. Let's pause for, you may only need to pause for about 30 seconds. All right, let's see how you did. This individual, if they did it right, the first 250,000 is only taxed at the first 1.45%, like everybody else. Not the entire 400,000 is not taxed at the higher rate. Only that amount over the cap, over that threshold, is taxed at the higher rate. And then when you add these two together, that's how much in Medicare an individual with 400,000 should have paid in through Medicare taxes. So that's actually a, remember the Social Security, we could have said it was kind of a benefit to the rich. This is a deterrent to the rich. This is, not helping. Big thing about FICA taxes, and I stressed this in week 1, but again, it's good to stress it again. FICA taxes are paid equally by both people, employee and the employer. Same amount. If the employee hits the cap, then that means the employer doesn't have to pay the Social Security either. Whatever one pays, the other pays. Remember, the employer, the money comes out of their own pocket. So now I have quite a few examples that I want us to try. Example 2, then example 3. Example 2, and as most of the examples that you'll see in my type of classes, they get a little bit harder, a little bit more involved every step that we go on. So this first one's not too hard. This individual works 40 hours, earns 15 bucks an hour, and I just want you to be able to tell me how much in Social Security and Medicare taxes would be withheld from her pay, and she only earns 20,000. Then I want you to go on, and might as well do this one as well, because we have our second employee who is a CPA, makes really good money, 5,000 a week. I want to know how much would be taken out of her paycheck for the FICA taxes, assuming she's already made this amount for the year. So go ahead and pause the video at this point. The only way you're ever going to learn this material is if you actually work it out and then see how you do. So pause, take my advice on that, pause it here, and we'll go through the answers. All right, so hopefully you've paused. If you haven't, do it right now, because I'm going to go through the answers here. For example, number 2, we got to first determine how much this employee is made, or how much they're going to make this pay. They make 600. They're nowhere near the cap. They've only made 20,000. The cap is 137.7, so nowhere near that. We don't even need to mess with step 1 and 2, if you remember that from last week. So we can just tax the entire 600 at the 6.2% and tax for Medicare at 1.45%. So this is how much the employee by themselves would have taken out of their paycheck. Now, when we get to our second one, Haley, she's a little bit more complicated because she meets the threshold, she hits the cap. And so we're going to go back to our week 1 and our 2 steps. And so as a review, what our 2 steps are, we need to first determine if at this pay, does the employee go over the threshold? And the answer is yes for this one. Because when you add up their prior pay plus their current, it's 140,500. That's over and beyond the cap that we're looking at. Remember, the cap is 137.7. So all we had to do is answer yes or no. And if we answer yes, we go on to step 2. And once we answer yes, then we forget all about the 140,500. We wipe it away. It's no longer applicable. It's actually going to be deterrent if you remember it. If you answer no, then you just take the full amount and tax it as normal. Just like we would have done in example 2. The answer was definitely no. When you added 20,000 plus 600, we were nowhere near the cap. So we just taxed everything by 600. So with this one, we answered yes. So our second step says, okay, well then take the cap as your first number and subtract out your current wage, or your prior wages. How much have you already made? That's going to then tell you what's left to be taxed. Then you're going to use this number and multiply it by the 6.2%. So this check here will be your final check for Social Security. Any checks that you get after this, any pay periods till the rest of the year, you're not going to have any Social Security taken out. This would be your final one, because now you've hit the cap and everything else is over the cap. So this individual is going to have 22 taken out for their check this period for Social Security. Medicare, they just do it as normal. There is no cap, so we take the whole 5,000 at 1.45%. So now that takes us down here to example 4 and 5. Actually, just 4. We'll do 5 second. Number 4 here says, well, if you take what you got in, and I need to change these numbers because these aren't, this needs to be 2 and 3, not 1 and 2. If you use the examples up above in examples 2 and 3, how much does the entire company owe to the IRS for FICA taxes? So think about that for a second. Pause using your answers from 2 and 3 and see what you get. All right, hopefully you have paused and are now ready to check your work. For example 4, what we need to do is add up both employees, and then remember, we've got to double it. So we've got to take employee number 1, this was their Social Security, and multiply it by 2, because the employer's portion. And then take employee number 2 and multiply it by 2 for the employer part. When you add these two together, the company owes the IRS the FICA for their FICA portion of Social Security, $347.20. You do the same thing for the Medicare. You got to take employee 1 and take that amount times 2 for the employer portion. The 72 times 5 times 2 for the employer portion. Add those two together, and we're going to be paying the IRS for Medicare $162 all together, because we pay these together at the same time and you're going to see that we pay along with our federal income tax. But these two together, we would have a check for $509.60. All right, so using your payroll template, so you're going to want to get out from week 1 that payroll template. I want you to be able to determine how much Social Security and Medicare taxes are taken out for the employee, and then go through and journalize the payroll entry. And for right now, we're going to assume that all the wages are taxable for FICA purposes, because we're going to see in a little bit that that's not always the case. But for this, we're going to assume that all of the wages for this individual here, the 7,000 and the 7,400, those are all taxable. So at this point, you'll want to get out your payroll for Amy and Bob. And I think I actually just did that on my sheet here. But you're going to want to get out, and I'm going to have this later, but you're going to want to have your payroll template out. I didn't do it for this one on my answers, but it might be easier for you. You don't have to do it in your template. It just, sometimes it makes the calculations go a little faster because you already have some of those entered in. So I want you to take a few minutes. This is going to take you a little bit more time because you need to do the journal entry for both the employee and the employer. All right, so go ahead and pause and let's see how you do. All right, so hopefully you paused and you worked out the answers. Amy, as you can see, is coming close to the Social Security cap, and with her wages, she's definitely going to go over. Bob, he's already over the Social Security cap. He's already, remember the Social Security is 137.7. He's already above that. Last pay, he would have hit the cap and had to do a little bit different calculation. This pay, he's not going to have any Social Security taxed. So our answers here, I did this in this Word doc just because there wasn't too much going on yet. All right, so when we look at employee A, how much is taxable for Social Security? Let's see if I work this out down here. Nope, All right, so let's go ahead and do that here. I'm going to put a little star here because we're going to need to calculate for Amy how much is going to be taxable for Social Security. Social Security taxable. We do the 2 steps. We do step 1, and her step 1, if we take the 134.5, if we add in her current wage, that puts us over the cap. That puts us at 141.5, which is over cap. So at that point, we need to go down to step 2. Step 2 says, forget the first number that you got. Simply list the cap and then subtract out what she currently has, earned and is taxed on. The difference here is what she has left for Social Security. And so the difference, if you do it, it comes out to be $3,200 left for taxation. We'll say that for Social Security. So that's where I got the 3,200. So I'm going to take 3,200 times 6.2%. And then I'm going to take the full 7,000 and multiply that by the 1.45% for Medicare. If we were doing her final net pay, if this was the only taxes she had taken out, which isn't really going to be applicable, but just for this small little example, we would take 7,000, her gross wage. We wouldn't start this. The only reason we have this is to figure our Social Security tax. Once we do it, then this 3,200 is not needed. We could get rid of it. We take the 7,000 minus her Social Security withholding minus the Medicare, and that's where I come up with the $6,700. Now for employee B, I think his name was Bob. Yeah, Bob. He had 7,400 in wages, but we already saw that he was over the cap for Social Security, so that means nothing is left. So therefore, no Social Security tax. Medicare, take this full amount times 1.45. And then simply to get net pay, we'll take the 7,400 minus his Medicare, and that's how much he is due to be paid. Now, we calculate this out because we're going to use these numbers then to do our journal entries. This number over here, our gross wages, that's going to be our wage expense for journal entry number 1. So journal entry number 1 is going to start us out with how much they actually earned, $14,400. Then we're going to subtract out how much did I withhold for Medicare or Social Security and how much did I withhold for Medicare. And I'm going to list those two. And I'm going to list them as a withholding or a payable. They both kind of mean the same thing. They're both a liability. I'm withholding 198 total from the 2 employees, and I'm withholding 208 total in 80 cents. And then together, I'm writing 2 checks. I'm writing 2 checks that total out to be $13,992, assuming I'm actually cutting the check today. If I'm cutting it in a week or 2 weeks from now, I would have called this wages payable. Now we have to go forward, and this is journal entry number 1. Journal entry number 2, the employer's part, says, okay, we don't actually know what this one is yet. Initially, this one is kind of, just think of it as XXXX. We have to figure up how much in employer taxes do they have to have. Well, they're going to have to match the 198, and they're going to match the 208 in Medicare. Those we have to put in as a liability that we owe for. And we call that, when we add those 2 up, that's an extra expense on our part. An extra $407 over and beyond what I pay them, what their gross wages were. When you think of this, we actually lost $14,400 as the company. Now the employee didn't get all of that, but somebody, not the company, is getting all $14,400. The government's getting these 2, the employee's getting the 3rd one. So total, the company is losing out on all of that money. And then they're losing out on an additional $407 as extra taxes. So you could have done that one in your payroll register. We're going to have another one coming up, a little bit more complex, that we will do in our payroll register. I'll have as well in the payroll register. All right, so how can you possibly get away from avoiding FICA taxes? Well, if you're a company, you really want to get away from it, because that's a lot of extra money that this company had to pay. In my example, I had to pay an extra $407 that, heck, I'd rather not have to pay if I was the employer. So that's why companies would prefer to call you an independent contractor, because if you're an independent contractor, they don't have to pay you Social Security, or they don't have to pay into Social Security. They don't have to pay into Medicare. They don't have to do the hassle of withholding money out of your check. You are responsible as the independent contractor for doing all of that. And then not only do you have to have the hassle for yourself as an independent contractor to withhold your own money, you also have to pay their portion. So you have to pay double. You have to pay 7.65% times 2 as an independent contractor. So if you do that, if you take 7.65%, 7.65 times 2, or not 7.65, that's what they are total. If you take 6.2 for Social Security and you multiply that by 2, you're actually paying 12.4% of your net wages in Social Security. That's a lot more than 6.2, double. And the same with the Medicare. You're paying this times 2, 2.9%. You have to pay both your and the employer portion. So I give you a quick review here on what we talked about in our part 1, where these 3 are kind of the primary guiding factors, but not necessarily. You got to, all of these have to, or not all, but over half have to be met for somebody to be an independent contractor. And this is why you don't want to be an independent contractor. You would rather be an employee for tax purposes, at least. Once you are considered an employer, you have to enroll and get an employer ID number. It's just like having a Social Security number, but for an employer. EIN, that's their identification numbers. There are some employees who do not have to have taxes taken out, but for the most part, taxes are taken out for employees for almost all of them. The key one that definitely could affect some of you is if you actually go to the college and you work less than 40 hours for Ivy Tech, or if you move on to a different school after you're done here and you work at that 4-year school, you would be exempt from FICA taxes as long as you don't work, you work less than 40 hours. That's going to be the key one there. If you're a household employee who earns less than that threshold, then you wouldn't have to pay Social Security taxes. You wouldn't have Social Security taxes. Another weird one here, they kind of have their own system set up as if you're a railroad employee. They have a different Social Security that they have all by themselves. That's a whole nother bag of worms. Let's get into now the wages that are going to be taxed for FICA. So remember I said earlier, we're going to assume all the wages that the employee had was taxable. That's not always the case. Sometimes some of your wages can be cut back and you're not taxed on everything that you earned. But here are the primary items that you are taxed on. Your normal pay, any advances that you get, any back pay that you get, any bonuses that you get. So a lot of the same things that were taxable in our previous lecture, same things are taxable here. Now, some of the things, one big thing here that's going to be the key difference. These are still taxable for FICA, but we're going to see when we get to Module 4, it's not taxable for federal withholdings, is if you put money aside for 401k, for FICA purposes, you need to get this down. For FICA purposes, they still tax you on that money that you put aside. They still tax you for Social Security and Medicare. Even though you're not getting the money right now, they're taxing you ahead of time, and then you're putting it away into your retirement account, to your 401k or your IRA or whatever it is. Then the saving part is when you take it back out, when you retire, you don't have to pay FICA taxes on it. You're paying it now. Now, that's not the case for federal income tax and state income tax. They take this money out of the taxable calculation. And so you're not taxed on it at the time. You're only taxed on it when you take it out when you retire. Then you pay tax on your 401k money that's been withheld. So that's going to be a big one that's going to come up quite a bit. All right, let's come down here to specific items that are not taxable for FICA. So this is money that you earn, but then you do something with it, or basically your employer does something with it, and you never touch it, at least not right away. It does not go into your specific bank account. If you have money put away and to help or to pay for medical premiums, you're part of it, that money is automatically not taxed for FICA. And is also not taxed for federal, that we'll see later on. All of these that you see here are not going to be taxed for either FICA or federal, which is then the same for state. So if I make $40,000 and I had to put back $2,000 for medical premiums, what it's going to show up on my W-2 as taxable is only $38,000. It's like I only made $38,000 because that's what they're going to tax me on. It's not going to show my full wages, because then I'd be taxed at those full wages. It's only going to show the amount that's taxable. So the amount that's taken out for premiums is out. Anything that goes into my FSA, which is a flexible spending account. And a flexible spending account can have two different areas where the money goes. It can go to pay for medical bills, or it can go for dependent daycare. Dependent care or medical bills, you put money into a flexible spending. Anything that you put into a flexible spending that's designated for those two items only, you're not taxed on. So 100% dollar for dollar, you can pay for those bills that are going to come. Same goes with a health savings account. Health savings account is just like a flexible spending, but just a little bit better, because with the flexible spending, as we'll see later on, flexible spending, you either use it or you lose it. So if you put 1,000 away, but you only use 800 of it this year, then you forfeit that 200. So you need to guess pretty close, or guess on the low side. With the health savings account though, you don't lose it. You can put money aside and you can keep building if you don't use it. So that's the nice thing. You think, well, who would ever want an FSA? You can only have a health savings account if your medical premium plan that you have, your medical premium insurance plan, is a high deductible. That's the only way you're allowed to have a health savings account compared to a flexible spending. All right, so if an employer puts money into your retirement account, so remember up here, if you put money into it, you're still taxed on it. If the employer puts money into it, then that's free. You're not taxed on it. I shouldn't say free, but it's not taxed for FICA purposes. The employee part is still taxed, not the employer part. If the employer pays premiums for you to have life insurance premiums, so this is life insurance premiums, I should put that in here, you're not taxed on it. You're not taxed on the amount that they provide and pay for those premiums. You're not taxed on the amount that they pay for medical premiums either. Meals and lodgings, if you get meals and lodgings for free from the employer because it's for their benefit, meaning if you could not really be away from your job site long enough to go get food without something happening. Think of it like being out on an oil rig. You can't be 800 miles out to sea and then take a quick trip to Taco Bell to get lunch. So they're probably going to provide food for you. At that case, you wouldn't be taxed on the free value of that food. If an employer otherwise gives you free food just in the cafeteria, that is considered taxable income, because you're getting money, you're getting the value of something that you normally would have had to pay for. All right, let's skip down here to my example. And it's a kind of a similar example to what we did before, but I only gave you up to this as before. Now the new stuff. Connie has this amount of different items taken out of her paycheck. Dylan has some additional items as well. I want you to be able to now, using your payroll template, to go through, and if these are the gross wages, what is actually taxable for Social Security and Medicare? So when you pull up your payroll template, I already have this filled out, obviously, and I want you to take the time to do it. But you're going to use, remember we had some things highlighted in yellow from back in week 1. So you're going to fill in those. Then you're going to come over here and you probably had these highlighted in yellow too. You're going to need to put in these guys. And then if you did everything correct, and if not, we'll update it here. We need to determine how much of your wages are actually taxable. Okay, so I want you to at least give this an attempt. So at this time, go ahead and pause and let's see how you do. You're going to journalize and complete the payroll registry for this for these 2 people. Go ahead and pause, and then we're going to check your work and we'll explain a little further. Okay, so hopefully you've paused. First thing that I want to do is I want to fill in their base pay and their prior pay. So their base pay here, their current pay is $2,500 and $6,900, just from the amounts that I gave us. Their prior pay, all we got to do is simply take their former pay here. And if it says in our problem here that they're paid, I think it says somewhere. Well, we can tell when they're paid wages as of 12/15 and then their next payday is at the end of the month. That basically tells us that they are semi-monthly, so twice a month. So that means that they've been paid a prior of 23 times. So gross wages, this is how much they've made. Now this is going to be a little different. This we can't just take, obviously, this times this, because their prior wages are going to depend on how much was taken out of their check. Now I like to base it, we need to, in your payroll template, if you don't have this already, you'll want to now do it. You'll want to update your payroll template. And you can see that I start with H2, my gross wages. And then for the Fica taxes, because these 2 are both Fica, we do not take money out for the 401k, but we do take out, as you can see here in my formula, S2, we take out the medical insurance, that's not taxed, and we take out the flexible spending, that's not taxed. But we don't do anything with the child support, that's still taxable, even though I'm not getting the money. That's one of the items that's not included as a non-taxable. So how I got this 2,080, you're going to want, if you haven't already, you want your template set up like this to where you take your gross pay and then you subtract out these 2 items. And you'll see I did that for this guy as well. Took his gross pay and subtracted out these 2 items. We haven't talked about federal wages yet, so I didn't do that. But if you were to do this one, you would have taken your, you could start with this number and then take out your 401k, or you could take the 2,500 gross and then take out your 401k, medical, and flexible. Either way would be okay. So I didn't require us to do that because we haven't talked about it yet, but that's how we'll do it in a couple weeks. Now, the reason why I separated these out and the reason why I do the Medicare first, because the Medicare has no cap. So for this individual, it's no problem. Because if I go back here now, I can now determine my prior wages. I take this cell, the 2,080, as long as they haven't had any changes in wages. So I take K2, and then I multiply by the 23 prior pays. So looking at that, I'm nowhere near the tax cap. But when I look at this guy, he's real close to the tax cap for Social Security. He hasn't hit it yet. That's why both of these are still the same. So if I took 5,900 times by 23 pays, that's how I want to set it up in my template. So it always will do it like this. Then if there's ever something you don't get and you want to, definitely email me and we can set up a time in Zoom and I can help explain some of the formulas maybe a little bit better. But essentially we want it to always multiply by this guy. That's why I put in those dollar signs. So then I can just drag it down like I showed you in the template in our week 1. So what I want to do for Dylan here is to get this number. I don't want to just use 5,900 like I did for Connie. Connie was nowhere near the cap, so all of hers is taxed. All of her Medicare is taxed for Social Security. Dylan is not the case, because if I did 5,900, I'd go over the cap. Because look, 135.7 plus 59 takes me over the cap. I didn't even want to put the number in there so I don't get confused. So then I go down to step 2, take the cap amount, subtract out his wages to date. When I do that math, I'm only left with 2,000. That's how much is left for Social Security. So then when I come over here, my formulas are already set up, and they're saying, okay, take whatever's in column J2, multiply it by 6.2%. This one says take whatever's in J3, multiply it by 6.2%. If you already have all the formulas set up, this is already done for you. All I had to do is enter in this and enter in these guys. All the rest will self-calculate. That's the great part. Now notice here, the FUTA wages and the SUTA wages, we're way over the caps. Now I graded out because we don't need to do it here anyway, because we're not to that part. That's not till week 6, but we wouldn't have had to do it because they're way over the cap. They've made over 7,000 or 9,500 for SUTA purposes. Now we can use all of these totals to do our journal entry. All right, our journal entry, we're going to simply start out with our wage expense, which is gross pay. And then if you have referenced them correctly, they should match everything that we have. Social Security, Medicare. We don't have anything for federal and state and county yet. We're not covering that yet. And then we had some 401k, money that I have to pay to, let's say it was the Hartford company, money that goes to TIA CREF, money that goes to the flexible spending, and then money that goes to the child support, whatever court is dealing with that. Now the check, what I mean by check figure here, that's this guy. This is simply just referencing my net wages. This is just showing this number here, 6511. But if I want to make sure it's done correctly, what I'm going to want to do is like how I've done my other journal entries, take your amount in your wage and then subtract out all of your credits. And if you did that, that should match these two. The payroll tax expense, we haven't done anything with FUTA SUTA, but these employees have already gone over the cap. So these would have been 0 anyway. They only have to match what the employer paid or the employee paid. When you add up these two amounts, that is your payroll tax expense. Now I take it one step further and I say, go ahead and assume that the FICA taxes are paid on 1-15. So go ahead and make that journal entry. So that's why out here to the side, I didn't do a whole T account spiel. I just did these two because that's the only two that we're paying. And we're not even doing federal withholdings. So those are just zeroed. If I was to pay the Social Security, right now we had Social Security from the employee's part and then Social Security that the employer had to match. So a total of 505. That's going to be my first debit is the 505.92. Medicare, it ended up being 231. So I need to pay 231 in Medicare. And let's see, what else did it say? Assume the medical premiums and the FICA taxes are paid. So I go ahead and throw in the medical premiums as well, even though this would have been to a different company. I could have done it as 2 separate entries and that would have been perfectly fine, probably even better to do this as 2 separate entries. But just for ease sake, I went ahead and combined them and made one big journal entry and a total cash that had to be paid out, not all to the same company, because this would have gone to the IRS. This goes to the medical insurance company. Total cash of $21.77 being paid. Now, what I did up here is I told us in the problem that assume that the employer matches the 401k and the medical premiums. So whatever the employee had taken out total for Medicare and 401k, these two amounts, the employer is going to chip in and pay another bit of that. So the employer is going to pay 50%, the employee pays 50%. So down here, we're going to have an extra 401k expense that me as the company have to pay in. So that's why there's two numbers here for the 401k. Not just 920 goes into the retirement account, but double that. And then the medical premium expense has an extra 720 that's coming out of my pocket as the employer. And that's where I got the 1440, paying the medical premiums, and why I had to debit 1440 back in this journal entry up here. All right, I think this would be a good time for you to pause it real quick. We don't have a whole lot left, just another page or two, but if you need a quick break, this would probably be a good time. And then come back for about the last 10 minutes or so, and we'll finish out this lecture. All right, so let's go ahead and finish out here. For self-employment, remember you have to pay both the Social Security, both portions, and Medicare, both portions. You're going to pay this on your net income, so that's kind of the only saving grace. At least you're not paying it on your gross proceeds, because it would be even higher. Remember, it doesn't actually matter if you took the money out. It's based on your net income, not on the amount that you withdrew. You have to prepare what's called a Schedule SE, which is your self-employment part of the tax. You're going to pay both parts. We're not going to get too in-depth in this, but and we do this a lot more in tax class. So I just wanted to put that out there, what form you use. And we go through that in Accounting 205. We look at this Schedule SE in a little bit more detail in how you pay it. All right, the final portion of this lecture, and it's going to lead into next week, is we look at, well, how do I know when to pay my taxes? So remember, I had on here that says, on January 15th, you got to pay your FICA taxes. Well, how do I know that if I'm the employer? How do I know exactly when I need to pay those? Well, you do what's called the look back period. So what that means is you look at those 4 quarters ending June 30th of the prior year. So you think about wherever you're at right now in the current year. And if you're like in February, then you have to go back to the previous June 30th. Or like if you're only in September, then you just go back to your most recent June 30th in that current year. So you go back to the most recent June 30th, and then you go back a whole year from there, back to the previous July 1st even. So going back quite a bit. And you add up how much in total taxes did you have withheld and payable for that entire year in that look back period. If you had less than 50,000 total in that look back period for your FICA taxes and your federal withholding, so this is going to include federal withholdings as well. If you had less than 50, you're considered a monthly depositor. You have to figure out how much you owe and pay it once a month. And then see here, you have to make the payment by the 15th day of that next month. So when you've gone through December, your payment's due by January 15th. Every 15th of the month, you have to pay that previous month's withholdings. If you're a new employer, well, then you're not going to have anything in your look back period. It's going to be zero because you're new. So you're automatically starting out as a monthly reporter. You become a what's called a biweekly depositor if you had over 50,000 in your look back period for federal and FICA taxes. in total, not just the employee's part, but the employer and the employee together. Then you're going to make deposits every other week. And then finally, the 1-day rule. If you're a really, really big employer and you collected payroll taxes that pay, and you had over 100,000 in liabilities that is ready to be paid for FICA and federal, you have to pay it by the next day. That's called the 1-day rule. And if you're ever in that category and you were previously a monthly depositor, you automatically at that point become a bi-weekly depositor. I got to change that. It's not bi-weekly. It's not semi-weekly would be you have to pay it twice per week. No, that's not the case. So that was it happens all the time. All right, if you're a really, really small company and you have less than 2,500 in your FICA and federal withholdings, and it's less than that for the entire quarter, then you only have to pay every quarter. And you pay that right along with filing your 941. And we're going to talk about the 941 in great detail next week. The 941, just a few basics before we get into it next week. You've got to file the 941 every quarter. So that's kind of a summary, a recap of where you've been the last quarter and making sure that you've paid the right amount of FICA and federal taxes. Notice when you have to file it, you have to file it by the following month, the end of that month. So every quarter, so the first quarter ends March 31. That means your 941 is due by April 30th of the next month. Notice here, you can extend it 10 more days if you've made all of your prior deposits on time. So you could have up until May 10th to do your deposit or to file your Form 941. Companies who are really, really small, this isn't going to happen for most companies, but there is a form out there, so you wouldn't have to necessarily do this every quarter. If you had less than 1,000 in FICA taxes and federal withholding, which is pretty small, really, really small, you could apply and be approved to do Form 944, which is only a once a year. So you're not burdened with doing this 4 times a year. Most companies are going to have to do it 4 times a year. All right, with that, the major point for this lesson, and you'll want to go in and do the practice. I have the answers here for the practice, and I'll have those attached in the answer section. Go in and check your work, and it's going to be very, very similar to what we did in the lecture example. So try the practice and then check your work in this tab here. That concludes week 2. You have a discussion board, and then you have 2 general understanding type quizzes. And we're actually going to get into our payroll register, back into that again in more detail next week.